Okay, we're live. Portfolio Builder members, welcome to our January 14th trade alert where we're playing the emerging markets ETF. In our portfolio, we had a $2,850 profit week over week, and that's after paying off our downside protection. We're doing a very similar trade today. And just to reiterate, this is what you would have received in your text message if you are on the paid program or a 30-day trial. If you're catching this on YouTube, keep in mind you're likely getting this a day late and $1 short. So go ahead and take your free trial and you can join our team of traders live every day. Now, your put option will expire worthless because it's only worth a penny. So that's fine. You can go right to step 2, which is to buy to open your January 24th, 45.23 emerging markets put. There will be no call options sold on this position until we reach 52 plus. In fact, I think it can go probably closer to 64 before we get to the end of 2020. So that's between a 15 to 30% rally. And I do suspect it will outperform SPY during this brief period of time at a rate of 2 to 1, if not better. And so we'll take a look at some of the data in a minute. Here's our risk graph. You can see we risk at most $87 based on an investment of $4,592 per 100 shares of emerging markets. Now keep in mind, we recommend a 2 to 1 ratio of emerging markets to the SPY. And that's about a 2% potential downside risk on 10% of our portfolio, or 0.2% we can lose in our total assets week over week. Essentially, the bet is that we're going to pay 18 cents for downside protection, and that put option kicks in after we've lost approximately 70 cents on the underlying. So after 70 cents of pullback in the emerging markets ETF, our losses would be cut off. So let's say the Chinese turn around and go right back home. They don't buy anything from the US. And we start putting restrictions on this ETF. It could be done in a snap. This puppy could be crashing all the way to 20. It wouldn't matter because you had the smarts to buy downside insurance. And that's our strategy. So our bet is that emerging markets will appreciate at a greater rate of 18 cents between now and next Tuesday. And if the catalyst tomorrow doesn't do that, I don't know what will. At the same time, I'm expecting the Fed's balance sheet, which is the primary driver of emerging markets, not the Chinese balance sheet, to grow rapidly this week after seeing a slowdown and actually a reduction last week. So that's our trade alert. Now, do note we're playing emerging markets a bit different than GDX. Keep in mind, in GDX, we bought an in-the-money put option instead of a near-the-money put. And the expiration on GDX keeps us in the position until February 28th. That's because I am expecting some potential volatility in gold on all this positive euphoria surrounding the US-China trade relationship improving. Now, with emerging markets, I expect it to start heading towards its 2018 high of 52, and then eventually breaking out of that all-time high into new highs into 2020. And so if that's the case, we want to trail emerging markets with a put option to help remove volatility and lock in the profits as our prediction plays out. So that's why we're buying relatively cheaper puts, and we're only buying it to protect us for 1 week at a time. As soon as we get towards 52, expect to start utilizing the covered call strategy, which converts this married put into an option caller. Now, if that sounds crazy to you, don't worry, we'll make this very easy to follow. The bottom line is we want to take some extra risk in the next several months to capture this potential 15 to 30% move and then get more defensive in this position. Also keep in mind, this does represent 10% of our total portfolio, not 40% like we have in the SPY. Now we are in a position to capture a large profit in the SPY tomorrow, and we will continue to play that into next week. But we will have a little more safety because it represents 40% of the nest egg versus only 10%. Okay, so that's the result. Now I did post, rather than the total returns, today I decided to update our emerging markets portfolio. Now, 22% return in 2019, up 1.7 in 2020. It did have a bit of a drawdown in the Christmas massacre 2018, where stocks fell over 20% from October through December. So this portfolio is designed to have more volatility, higher returns, and I do suspect it can dramatically outperform the SPY, at least for the next 3 to 6 months, potentially even the next 9 months. Now, as you know, my expectation is that the long end of the yield curve will rise throughout the year until that eventually causes a sell-off in stocks and forces the Fed to cut interest rates. Okay, so what I want to do real quick is play the analysis behind this video and then a second video clip with the hot news, and then we can jump into Q&A and review our other open positions. So let me play this next video. I'm just looking at the chat box. So yeah, 45.50 is correct. And they also have some oddball 23 cents. Okay, so let's go ahead and play this video. Trade alert on emerging markets. We're going to be betting big on emerging markets heading higher into the next 2 quarters, assuming that they will live up to the agreement to purchase around $50 billion of goods from the U.S., including manufacturing products such as automobiles, energy products, as well as agriculture. Now, if we do look at the long-term chart of emerging markets, it's been a tough ride for investors. And my expectation is that it can break out beyond the $52 price we saw at the end of 2018 and head into new highs. So if we hit 56 to 60 as a reasonable range, we're looking at anywhere from a 15 to 30% return on emerging markets. Now, of course, there is some serious downside risks, which is mainly if China's growth doesn't recover, then this whole picture for emerging markets traveling higher for longer could be short-lived. But with US, China, Japan, and Europe doing monetary easing as well as a lot of fiscal spending, I do expect we can get some more growth going into 2020. A lot of the PMIs are rebounding, and it does look like we're set for somewhat of a modest growth picture into 2020. So we'll be using the married put, which allows us to buy the put option. Let's zoom in a little bit. And so our main strategy here will be to buy an inexpensive put option, so we have downside protection, and then from week to week, continue to trail behind the emerging markets with a new put option. And this way, whenever there is a sharp sell-off, we can lock in our gains and not be caught holding the bag in case something goes wrong. So the basic bet will be that the cost of the put option will be less than the growth of the ETF in most weeks. So hopefully this trend will go for at least the next 6 to 9 months before we have to start worrying about yields on bonds getting so attractive that it could cause a major sell-off. The other thing to be tracking on this is if China is really living up to its promises. However, I highly doubt the U.S. will aggravate this relationship until after the election. So once again, I am expecting to see Trade War 2.0 come out of the gate in 2021 as we start arguing about more difficult problems between the U.S.-China trade relationship. Now, when I do overlay the different components of China's core trading partners, as well as emerging markets, we have MCHI in orange leading the rally relative to emerging markets. We have in yellow South Korea, a key trading partner and exporter, a great leading indicator for stocks in general. Then we have Germany in the blue, as you can see, still lagging behind the others. Now, the transparency in Germany is much more clear than in China, so it can be a great indicator towards the health, but it's still rebounding, and so all signs are pointing towards a rally in emerging markets going into this U.S.-China trade deal. Now, keep in mind, emerging markets is trading at a PE multiple closer to 15, whereas the United States is at 18.6. So just for it to have a modest catch-up in PE multiples relative to the U.S. gives it a huge advantage in the next several months for generating return in our portfolio. Also, it's nowhere near its all-time high, whereas U.S. stocks continue to head higher and higher, pushing the limits on PE multiples as we go into earnings in this next several weeks. Now we're looking at DXY, the dollar index, and this is going to be critical for our strategy in emerging markets. We really need to see the dollar weakening for emerging markets to do well for a sustainable amount of time. And with the Fed expanding its balance sheet and keeping interest rates low, also with the Fed being trapped into expanding its balance sheet because of the U.S. deficit, I do see this as the most likely outcome. So we want to keep a close eye on the dollar index to try to keep a long position in emerging markets where we're aiming for this, again, 15 to 30% plus rise. And I think it's actually going to be closer to 30% return before, again, we start to worry about the bond market's yields rising so high that it can cause stress in equities. Another great leading indicator to predict the direction of emerging markets, as well as U.S. stocks as well, has been to see a weakening dollar against the Chinese offshore yuan. And you can see it is selling off as it was unlabeled as a currency manipulator last night, which is one of China's demands. And so China is strengthening their currency dramatically over the last several months, and I suspect this will continue as long as the U.S. removes tariffs. Right now, it's not clear what tariffs will be removed, and if any will be, and if so, under which circumstances. So tomorrow's report or fact sheet will be very important, but it does just look like China wants to start buying up a lot of goods and not be in the crosshairs of the U.S. trade policy battle, which now may move its directions toward Europe until after the election. So this is strengthening. However, as you know, if they were really to let the currency freely trade and let all the capital out of China that's trapped, this would surely devalue very, very rapidly and probably push towards 10 in a heartbeat. So this is a exchange rate that they have to spend a fortune to guard, and it's what the key valuation for the value of their economy is based upon, which is this huge amount of trillions and trillions of yuan that they've printed and claimed are worth 7-to-1 against the dollar. Now, just as there's a bond market for the U.S. stocks, which we can track via ETFs, there's something similar for emerging markets corporate bond ETF. We can see that this has sold off slightly from 59 down to 56.7. However, it is rebounding and still at levels that were less expensive to borrow than we saw in the high of 2018. So I do suspect that the emerging markets corporations will have easy access to capital for the foreseeable future, which backs up our trade to be long emerging markets. The other ETF to keep an eye on is EMB. And while it's not as healthy as it was back in 2013, it's still at the same levels we saw during the most recent high in emerging markets in 2018. So this is pointing towards easy access to capital for emerging market companies. Okay, next we're looking at GDX. And we basically need GDX to go up to about 29.15 to start generating profits. We bought an in-the-money put option that expires February 28th. And the big picture on this is that if we're in a period of quantitative easing, which it appears we are, we only have to go back to 2009 to see how the effects of QE1, QE2 had on the markets, and gold outperformed stocks during that period of time, especially gold miners. So I do believe we have a decent 2020. Now, if we just have modest quantitative easing and low rates, but not zero rates, I do think we can still see bigger returns in GDX in 2021 and 2022. And just for timing, again, my expectation is that the Fed does quantitative easing for much of 2020, which causes yields to rise on the long end of the Treasury curve, and eventually that's what causes stocks to sell off and forces the Fed to begin cutting rates and going into real QE. Now, timing-wise, I suspect this will happen towards Q3 or Q4 of 2020, and then lead into real QE into 2021. Now, keep in mind the difference between fake QE, as they call it, and real QE is just which spectrum of the yield curve they're purchasing. If it's short-term debt that expires and can roll over quickly, they call it not QE. If it were notes or bonds which have longer than 1 year duration, then they do call it quantitative easing. So the true quantitative easing is what would really push GDX higher. Again, our strategy was to buy the in-the-money put, and that way we can sit on this position with no risk other than the cost of the put option for the next 2 months. And basically we just need GDX to appreciate by 2.5% to break even, and then after that it goes into pure profit. Now, if GDX crashes 5, 10, 20%, we won't lose a penny more than what we purchased for our put option. So it's a very safe, easy way. Now, unlike emerging markets where we're chasing the stock up, expecting big jumps in the near future, I think that we need to be a little more patient with GDX. So I'm trying to save investors some cash and be able to just buy that 2-month put and sit back and relax and let this appreciate over the course of 2020. Emerging markets, I want to chase that ETF as it travels higher and keep that put option snug below it until we do get towards that $52 to $60 range. Okay, now we're looking at the TLT, which we've been betting down on. Last week we had a nice profit, and I think we can still pull off a profit this week. We did have a little bit of a bounce on the TLT, and again, there was no debt issued and auctioned off this week that was in the TLT spectrum. But with the U.S.-China trade deal being signed on Wednesday and our trade closing out this Friday, I do suspect that we can see a relatively sharp sell-off in the TLT and strong bounce in emerging markets and the SPY into the next 2 days. And again, this is a trade we'll be putting on for at least the next 3 to 6 months, possibly next 9 months, until we see the TLT sell off to around 120. And that's where I believe yields will begin to become so attractive that we need to become precautious on our stock position. And I'm expecting the SPY to get towards 350 to 360, emerging markets to get between 55 and 64. GDX, hard to predict depending on how aggressive the quantitative easing is. We're just going to be playing that with that very defensive put option. And then meanwhile, again, I do suspect that the long end of the Treasury curve will have rising yields in 2020 as stocks soar higher, and this should drive the TLT sharply lower. But again, there's so much debt. We're now at $256 trillion in global debt, and the cost to manage these debts is getting more and more expensive, and that's why rates are bound to go lower. after we see them rise and most likely crash the stock market at some point in 2020. So expect to continue betting down on the TLT, and I still think we can pull a big profit on this position Thursday based on the catalysts we have today and tomorrow. Portfolio Builder members, today. Okay, great guys. I have one more video to play for you, and I did try rendering in a square. Yesterday we were missing the dates on the bottom. Today we're missing the price on the right, so I apologize. I'll have that fixed for tomorrow. Let me play the next clip. Okay, some other analysis we want to take a look at. First of all, is China growing their money supply? And yes, they are. You can see in the year 2019, they've grown it significantly and continue to do so. Now, their central bank balance sheet has not grown as much, but their money supply is growing. And again, that is primarily how they like to expand their debt levels. If we go over to Germany, they are trying to have more prudent fiscal policy, so we can see that they have flatlined the growth of their balance sheet. South Korea has been growing their balance sheet, and again is a key leading indicator for exports, which is important if we want to be long stocks. If we do go look at this Zero Hedge article, some of the headlines is that China agrees to buy more cars, although their car industry is plummeting and they're trying to shift over to electric vehicles, airplanes, energy from the US, and agricultural products. And now China's essentially saying, we'll see if the US can create enough goods that are competitively priced. So we'll see how this all plays out. Goldman Sachs is saying that they want to double their staff in China as long as China's going to really open their markets. And so this will be a very interesting set of news flow coming out in the next today and tomorrow morning. We'll see exactly what's in this agreement. Meanwhile, here's a clip from Yardeni Research. Now, there was a whole bunch of Fed speakers coming out over the past few days, but the highlights, which he did put out very well, is that Ben Bernanke and Janet Yellen have come out and essentially said that we don't have to worry about not having ammunition at the Fed because we can use a few tools that we haven't used yet. Number one is this idea of forward guidance, creating the effects of quantitative easing, just telling the markets what's going to happen before it happens. And remember, we're stuck at this 1.5 to 1.75 range. In the last few recessions, that they had to cut rates by 550 basis points. So that's number one. Number two, they're saying that they'll be able to potentially go into negative interest rates. Number three, that they might be purchasing bonds from corporations rather than just from the Fed. Also, that they're going to potentially create a repo that will loan directly to hedge funds instead of through the banks. So a whole bunch of things we saw out of Europe and Japan are now coming out of the mouths of some of our previous Fed leaders. And we're starting to see Powell nod his head that this is potentially appropriate. There's just about no expectations of raising interest rates, even though inflation continues to grow, even with the print this morning on the CPI. So quite likely we are going to see some pretty extraordinary monetary policy in the next few years, pushing rates to zero, going into full-blown QE, and recreating exactly what happened from 1965 to 1970, which ended up in massive inflation and forced Paul Volcker to hike rates significantly higher. There's a new Fed minutes out in December, and this all lines up exactly with this whole host of speeches that have been given over the past few days. Some highlights from Twitter. China pledges to buy nearly $80 billion more in U.S. manufactured goods over 2 years in Phase 1 trade deal versus 2017 baseline. Trade war. China-U.S. may not release full details of Phase 1 deal set for signing this week. In fact, what they're saying now is we'll get a fact sheet. It'll probably be just enough to get markets very excited. And then if we see a big increase in the balance sheet Friday, I would not be shocked, probably for the next several weeks, due to the massive amount of T-bills being sold. And again, the Fed's balance sheet is the key driver, even for emerging markets ETF, because this is still an American product and not really relying on the Chinese at all for these investments into EEM. Next round of Democratic debates tonight, and here are your forefront leaders: Bernie, Joe, Warren, and Pete. And right now it's looking like old Bernie could take the lead. We'll see how this plays out. And this may become the new headline risk in U.S. markets as we see how these two poll against each other leading into the November elections. Also, we have impeachment heading to the Senate tomorrow, most likely. And we're now seeing a lot of these elitists talking about climate change, whether it's Christine Lagarde from the ECB, BlackRock CEO this morning on CNBC, and now we have Bloomberg making it a primary concern for his, whatever he's doing to run in the elections, although he's not participating in the debates. Maybe he's just running for vice president, hard to say at this point. But this could be the excuse for some massive spending into this sector. And as predicted, the Fed injects $82 billion in liquidity as term repo is most oversubscribed in 1 month. And this is from the huge issuance that was delivered yesterday, some $76 billion of T-bills, which will surely, for the most part, go to the Fed's balance sheet after changing hands with JP Morgan. Quite a deal. Cryptos are surging, Bitcoin at 2-month highs after CME options start trading. Keep in mind, we've been recommending this all year, a 1% position in Bitcoin and a 1% position in Ethereum. The second it represents more than 1% of your portfolio, take profits. The second it represents less, add to the position. We have quite a long runway to 0% interest rates before we have to worry about the Fed hiking interest rates, which would be disastrous for crypto. So we are believing we could see Bitcoin double and Ethereum triple or quadruple in the next 12 to 24 months. And we're about to go live, so I'll leave it at this. China's trade figures for 2019 demonstrates overall stability. Exports up 5%, imports up 1.6%. And don't forget, they did devalue their currency a little bit during this period, but here's such a world's second largest economy deserves the respect of the U.S., the world's largest economy. China cannot be crushed. It can be a suitable partner. It is hoped the Phase 1 trade deal is the beginning for China and the U.S. to explore a new constructive bilateral relations. Okay, guys, we're going live, so I'm going to end it here. But these are the key highlights for today. Okay, great. Karen says, I suspect Davos will be the love fest of climate change hawks as they all arrive in their separate Learjets. Oh, Karen, you crack me up. Very good, very good. Okay, so let me review our open positions and then go into Q&A. So again, we closed out our emerging markets position. There was nothing to do on the put option, allow that to expire worthless, and then pick up the new put, which will keep us safe from now until next Tuesday. And again, we're risking about 2% of 10%, so 0.2% maximum loss week over week. And the potential gain is much larger than that. Just a 40 to 80 cent move I'd be very happy with, like we had week over week. Now, with the big news, I do think we could potentially see $1 or $2 added to emerging markets before next Tuesday. And it's no coincidence that there's $82 billion in repo today after issuing $76 billion in T-bills yesterday. So I suspect this will soon be in the Fed's balance sheet. Now, normally the Fed says they're only going to buy old debt, but now we are tracking the cusp IDs and they're literally buying it fresh off the minting press. So JP Morgan buys the debt, flips it to the Fed. And again, JP Morgan had the most successful quarter of all time for any bank in history after creating this whole repo madness situation. So good for JP Morgan. And again, makes sense to pay attention to what they're doing and how they're playing the markets. And of course, listening to good old Jamie Dimon. GDX, we're currently down 9 cents. And again, we're going to need GDX to get over 29.15, I believe, was the price point because we paid, we entered the position at 28.12, paid $1.59 in protection. So once you take the differential, we have to pay off that put and then go into the profit. So again, we entered GDX with a 2.5% loss when we bought the in the money put. And our bet is that between now and February 28th, GDX will appreciate at a greater rate than 2.5%. And I think it could return anywhere from 10 to 30% over this period. And I believe we'll see GDX rally alongside stocks so long as the Fed's balance sheet is increasing, which is almost surely to happen. Otherwise, the US government's not funded. It's just that simple. TLT has been a wild one for us. Last week, we were hanging on to a loss until Thursday and then closed out a $3,344 profit. Today, we're still losing on the position by $1.77 a share. I'll be willing to delay closing this trade out Thursday if necessary and close it out Friday with our SPY position. So just be aware that Thursday we may just do nothing as we have our put option protecting GDX. The big news coming out tomorrow should cause the TLT to sell off and stocks to rally. So I'm not worried about this position, and we will continue to place the same trade on TLT until we get to that 120 range. To reiterate some of the questions, we had a question, what would you build in your portfolio if you couldn't afford the full trading plan right off the bat? Okay, so in the near term, my favorite pick is emerging markets simply because of its lower PE multiple. And it's sort of that smash and grab strategy. US smashed emerging markets with tariffs and lots of sanctions. And now they're pulling it all off. So that does give emerging market a lift. It's much smaller market cap, so it can rally with a lot less volume. Meanwhile, SPY's trading near all-time highs and at much higher PE multiples. Now, that doesn't mean I think US stocks are going to crash. I just think emerging markets could outperform. So that's my favorite pick out of SPY versus emerging markets. GDX, I believe we will see a good return in 2020, but a great return in 2021 and 2022. And that's only if I'm correct in that we can keep rates flat for most of the year before we have to cut rates to save the stock market. Now, if they have to cut rates sooner and begin purchasing notes or bonds, then I think GDX will outperform all of these assets immediately. So that's why I don't want to be too safe with GDX, and I'm willing to simply buy that put option, the in the money put, and bet that in a 2-month period, GDX will appreciate at a greater rate than 2.5%, where I start to earn profits. Now, as far as a fast bang for your buck, a little riskier, but again, this is a hot trade that's been put out by Stanley Druckenmiller, also Jeffrey Gundlach, is that the long end of the Treasury yields will rise into 2020. Makes a lot of sense. In 2019, the bond market got way ahead of itself, expecting the US trade deal to continue escalating and for China's growth to continue collapsing. But we're starting to see rebounds all over the place in PMIs. We're seeing quantitative easing at the big banks where it really counts. We're seeing fiscal spending, which will create positive GDP growth. So really, there's a lot of pressure for the bond market to rise and get to some healthier yields. So I do really like that play on TLT, but realize it is correlated to our stock position. So that's the best breakdown in terms of the trade schedule. Again, we trade the SPY Monday, Wednesday, Friday with the most extreme precaution because we can follow the price of the SPY 3 times a week and really trail it with a put option. And we're financing that put by selling a call. So it makes for a very easy trade that a lot of members really enjoy. In fact, a lot of our members just exclusively take that trade. Emerging markets has the potential to outperform the SPY, most likely by a factor of 2 to 1, maybe as much as 3 to 1. I'm looking at a 10% rise in the SPY from here to get to that 360 range, 350 to 360 range, where I think we'll see TLT getting towards 120 around the same time. So if that's correct, and we catch a 20 to 30% rise in emerging markets, that's how we can see EEM outperform the SPY by a factor of at least 2 to 1, maybe 3 to 1. Now, keep in mind, it has underperformed the SPY for the better part of a decade and is really just starting to catch up as of December once this relief from the trade tensions was removed. Key indicators to continue this bet on emerging markets is to watch the dollar. If the dollar is strengthening, that means trouble abroad, and we could see a repeat of 2019 where US stocks went up and everything else was having a hard time and selling off. So that's really the key indicator there, is to watch that dollar strength. In terms of the treasuries, the only thing that I think might slow down its crash will be money getting out of negative yielding debt, which was $16 trillion trapped in 2019 into worthless bonds. And they all know that if they hold that position, it's a guaranteed loss year after year, unless rates eventually go even more negative than we saw in 2019. But you got to ask yourself, what's the catalyst to slow down growth in a worldwide spectrum and cause rates to go back to those levels? So they'd have to be potentially willing to hold these negative bonds by my measurement for at least a year, maybe 2 to 3 years before we could be back in a situation where rates get that low. Now, if inflation comes in, those negative yielding bonds are just outright in a bad place. So I do think we're seeing some considerable money rotate into US yields, and that's helping support the TLT. But as we see stocks start to rally and this China trade deal signed tomorrow, I think that we'll be happy in our position on the TLT. Okay, great. Let's go ahead and open up for Q&A now. I'm going to go ahead and unmute everybody and see what questions we have.
Hi, this is Mark. I have a question.
Great. Go ahead, Mark.
If you're expecting such a large increase on the EEM, would it make sense to maybe bump the position size up just a little bit?
Yeah, I would say if you are willing to have more volatility, and that's not a bad move at all right now. So when I do pull up the Tuesday trade, just keep in mind that, I am trying to take on more risk for a higher return in this portion of the portfolio. And if you've noticed, the trades are designed less with trying to earn a profit, more with the concern of how much can we lose. So by controlling our risk, we can really design our risk profile and make sure this is in line with our goals. So with our audience, most of you are over 60, you're in retirement, you don't have new income. So your core concern should absolutely be preservation of capital. Now, if you feel like you're willing to take a little extra risk because of this catalyst, then sure, yeah, I think that's not a bad idea. Especially considering we're not just long emerging markets, we're trailing it with a put. So yes, I think that would be a perfectly fine move right now.
Say, Jason.
Hey, Donald, how's it going?
Good. How about yourself?
Doing great.
Say, I was just curious if anybody could. I'm in the process of rolling over to all my accounts to TD Ameritrade.
Nice.
What kind of pricing did they get on today's trade on that January 24th EEM 4223? Can anybody
on the new put up?
Yeah, on that put.
Here, let's, the 18 cents is what I had on it.
Okay, that's what I got. I'm just curious. Like I say, I'm trying to get my hand around this TD Ameritrade thing, but that corresponds with what I got also. Thank you.
Excellent. Well, that's good to hear. And in a little bit, Donald will be demoing how to trade from the Thinkorswim phone app in our bootcamp module coming up. So
yeah, I'm definitely going to be there for that.
Oh, good. Very good.
Nice, Jason. And hey, just want to tell you, bud, way to be early on EEM too. Holy moly, you can see the volume flowing into it this year. It's insane. And man, we got a great entry last year, but heck, we got a long way to go on this thing.
Yeah. Well, so keep in mind, you have the two big positions are Alibaba and Tencent. That's your kind of your all-stars. There's some other good companies in there. In the SPY, it's your Apple, Microsoft, Amazon, Google. So the emerging markets has good exposure to technology companies in Asia. The only thing we really don't have in our portfolio is a whole lot of European exposure. But in our boot camp, as you know, we do have 2 English banks to take advantage of Brexit, as well as some other 2 copper companies. So when you look at our full portfolio, we really have a beautiful set of companies that we get to have exposure to, even though it's only 4 ETFs. All right, guys. Well, are there any last questions before I let you go for the day? Again, we do have our boot camp coming up in 1 hour, where we're going to go over all the different types of trades we may place, as well as a demonstration on how to use the Thinkorswim phone app, which makes this program even more easy to follow. And yeah, so I think people enjoy that. We'll look at about 55 slides, just kind of showing you how we can slightly change these options and get different results.
Yeah, Jason, it's me. It's Karen.
Hey, Karen.
Hey, we're talking EEM today, and that's great, but I'm kind of thinking about tomorrow. And although I know we're very long-term in our focus, I'm very curious about your opinion with tomorrow with this signing. Which way you think the SPY is going to go? You think it's going to pop, or you think it's going to be a sell on the news for the day? I'm just kind of curious what you're thinking.
I think it's going to travel higher, and I think we're going to see the Fed's balance sheet grow on Friday. Okay. After seeing that reversal last Friday, which was a little bit nerve-wracking.
Yeah. Very good. Thanks.
Yeah, but we'll see. It's could be a random walk in the short term, but in the big picture, yeah, there's really big picture is money is going to be getting out of low-yielding bonds and flowing into equities. At the same time, governments are going to be demanding that their central banks buy up its debt, which expands the money supply. So if we keep the same amount of shares, and if there's 10 nuggets everybody wants to buy in the middle of a circle of people, and all of a sudden the money supply doubles, well, the value of those nuggets in the middle will relatively double as well. So that's really what we're looking at here in the big picture, is that the governments of the 4 major economies are demanding that their central banks purchase their debt because they don't have enough capital from their tax receipts. That creates a bigger money supply, and the number of shares of stocks is staying the same. So that's really the simple measurement for equities right now.
Okay.
So unless governments stop spending so much money, they're really trapped. They really just are trapped in this cycle of expanding their money supply. And what will cause them to stop would potentially be inflation. But we're seeing China absolutely ignore inflation. US is ignoring inflation. And so they're letting it run hot.
Yeah, it just feels like there's a lot of scrambling going on right now. It's interesting. It's just a feeling I have, and you know me, I go by my gut a lot of times. So,
Yep.
very
Sure.
good.
So the biggest concern is the way that all these banks take a loan or a bet, and then they turn it into a derivative, and then they take that derivative and flip it into another derivative.
Yeah, and then who knows
So
where it
that's
goes.
the big risk, is if there was a liquidity crunch,
Right.
that could cause some serious pain. But that'd be perfectly fine because we have a put option right below all four assets. So I'm not concerned about that.
Exactly.
Now,
right.
big billionaires don't have the luxury of trading it so safely and easily as we do. So certainly I do recognize that the market's extremely leveraged and that a liquidity event could cause trouble. But right now we're seeing the Fed happy to grow its balance sheet. And it's no surprise that a day after they issued 76 billion in T-bills, that the repo market is oversubscribed. So one can anticipate balance sheet growth come Friday. And we'll know that at the close of Thursday. But yeah, big picture is governments are spending too much money in all the major economies we're tracking. That's causing their central banks to buy the debt, increase the money supply, and shares are staying at the same quantity. So that makes the relative value of these shares go up.
Yeah, and Jason, Karen, while you guys were just on that, I was checking. I had an option scanner go off, and I just saw a $19.7 million single option trade for the QQQ 230s for March. So yeah, that's yeah. I think someone
Spies
just saw some
rallying.
paperwork go around. I mean, who knows, right? Who knows, but yeah, interesting single position, right?
Wow.
I'm telling you that that's one of the feeling I was getting was there's just a lot of positioning. Everybody, there's a little bit of a, there's a lot of stuff going on. I feel like there's a lot of rumblings and it's interesting. So, and yet we can feel a lot more confidence because of how you've positioned us, which is really kind of cool. But you know me, I'm always, I got my radar all over the place looking at this stuff.
Yeah, you're always busy. That's true.
I find it fascinating, you know. I like to try to figure out how these people are thinking.
Well, we love having you in part of our group. You always have great commentary, so thank you.
Even when I'm difficult, thanks.
You're never difficult.
That's okay. You can say it.
You're really not. You always have great commentary.
Oh, thanks. Well, I appreciate it. And I like the guy's idea about the extra EM. That was good, whoever that was. I was thinking the same. I'm glad he said it.
Yeah, Mark Stoley made that comment.
Good job.
Hey, this is Mark. I've got one more quick question. I'm not going to be able to make the boot camp this afternoon or in an hour. I've got to do something. I'm assuming that's going to be recorded, right?
Oh, yes, sir. Absolutely.
Okay, I'll go back and watch it later then. Great, thank you.
Sure, and I try to make it so each update has links to everything in the order you should digest the information so that it's easy to get caught up if you are joining the boot camp late. And keep in mind the boot camp does repeat itself over and over again. It's not a one and done. So it gives you more exposure with me, where we do try to take the education a level up from just simple trade alert videos.
Okay, and thanks, Karen.
Anytime.
All right, guys, well, I'm gonna go ahead and wrap this up so I can get ready for the boot camp presentation shortly. I really appreciate everyone's time, and we're getting a good crowd every day, 20 plus people. So that's wonderful. Thank you so much. And we'll see you guys in an hour.
Sounds great. And Jason, just real quick, bud, really enjoyed doing the Q&A session and overview with all the trial members before we started the presentation today. And just want to let you know that I'm going to do my best to conform my schedule to where I hop in about let's see, with 11 o'clock Eastern each day for anyone on a trial, for anyone that has questions, anyone that wants to go over just how this works and why we've designed it. Please feel free to hop in, interact with us live. We had about 4 or 5 people in this morning. Would love to have you in. And I know a bunch of you are still here, so thank you for jumping in. And please feel free to come back tomorrow. It's just really fun getting to know everyone a little bit and explaining why this is so defensive and safe and just kind of looking over everything we do. So I look forward to that opportunity on a daily basis moving forward. And, always, if you have any questions, feel free to call me as well.
Thank you so much, Dean.
Yep. Thank you, guys.
All right, team. We'll see you tomorrow. Same place, same time.
All right. Thanks, Imhog. Have a great day. Thanks, team. Bye-bye.